Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
Myself and my co-host, we're both financial advisors, helping people for the last few decades, and
yes,
been doing this podcast for radio show, now podcast for
how long?
A few decades.
30 years?
Over 30 years now.
Holy smokes.
Hopefully, we have 30 years of wisdom, and not 1 year 30 times over.
Yes. It's,
but you can be the judge.
It's funny as I reflect back over these last 30 years, cue the nostalgia music. Do you remember during the run-up to the housing bubble, about 50% of our phone calls had to do with purchasing a new home, right? And you could see where we are in market cycles just based on phone calls. And then a year and a half later, it was, how do I get out of this mortgage?
Right. Oh, yeah, it's funny. In the mid-2000s, the majority of our calls had something to do with real estate.
Yes.
And when prices go up on assets, for whatever reason, investors, not all investors, some investors want to jump in.
Yes.
Wow, things are up.
Yes. And then the .com, I remember the .coms, which was, you just throw a dart and you get rich. And so it was
1999, and I don't think a lot of people remember this, or if they do, they're quite a bit older, but I bet a lot of our listeners don't recall this. 1999, the NASDAQ, which is the tech index, that index for the year of 1999 returned 85%. 85%.
For that year.
If you just bought the basket of the cubes, QQQ, NASDAQ index, 85% return. And I'll never forget, I had a client that had a little side account going, and he was bragging about how well his trading did. And he was kind of questioning why he was even with us, sort of thing.
Yes.
Scott, my day trading, I was up 77% last year in my tech stocks.
Okay.
And I said to him, you could have just taken the year off and put it in the index and it would have done better. You worked for nothing. You paid to work.
What did he say?
Yeah, I don't know.
So I have two of my 4 children that will play in the market. And I always tell them exactly that. When they start talking about their returns or their losses, I say, you got to compare yourself to the index if you want to base. and they have curtailed their trading significantly after comparing themselves. So
don't let a bull market confuse you with wisdom.
Yes. So when we're in this market cycle, and is AI like the .com? I mean,
that's the question.
Yeah, if the investment is so great, you'd have to have like a Goldilocks scenario to get a ROI.
But I tell you, you look at companies' reportings this last quarter,
yes.
Something like 88%, don't hold me to that number. It's almost 90% of companies have outperformed what they had projected they were going to do.
Yes. And is that AI? What is it? I mean, there is some AI in there, and it isn't whether AI works or doesn't work. That's not a question. The question is...
Well, that's part of the question. Why is that not the question?
Well, because it's proven to work.
Okay.
Right? The question is, how efficient is it? How good will it be in replacing labor? That's what it's about. That is exactly what it's about.
Yes.
And is the investment... Remember the .com, the telecommunications companies built so much infrastructure to support the internet.
The fiber optic line. What was the Corning? I mean, there's so many companies, the stocks fell 90-some%.
After.
Yes.
Yes.
I mean, there's so many companies, the stocks just cratered. And they were the ones that were, a lot of them were, well, some were just had no business model whatsoever. But then the ones that were involved in kind of laying the cable.
That's right. The infrastructure.
We had way more fiber optic cable laid than we ever needed.
Which we benefit, all of America, all the world benefited from that because it actually opened up communications because it became a lot less expensive.
It's not that dissimilar to the airline. I mean, the railroads. When all kinds of investments flooded into railroads, most people lost money.
Yes.
There's oversupply to begin with. Same thing. And so the question is now, right? That's what I think.
That's what I'm asking.
Concerns me. All these huge energy production facilities, these massive warehouses of
because the infrastructure and to communicate is already bought and paid for, right? The existing infrastructure for that. So now we're just talking about plant facilities,
right?
Plant facilities, and
we need energy, and we need, I guess, their old computers to store all of
the billions and billions of dollars that have been pledged toward this. You're just like, well, these aren't all going to work out. That's just fact.
For sure.
There's going to be a good 60 to 70% that actually never make it. Just don't get the ROI that they've expected. They would have been better off owning treasuries in that time period.
Yeah.
But there will be 30 to 40% that will just become.
And some will crush it. And some of it's already been priced in that they're going to crush it.
That's right. Most of it's already been priced in.
I mean, that's what feels so strange right now.
Well, it's different than the dot-com because the dot-com, many of those companies were just flat out. They could never, ever make the kind of return associated with their stock price because it had been priced in and the business models
That's
were
right.
failed.
They had no business model.
Yeah. Like Pets.com, right? When they went into bankruptcy, their number one asset was the talking sock puppet when it was sold.
And that asset's worthless today. Where's the talking sock?
Yeah, I don't know.
I know you haven't seen the talking sock in 25 years.
So that's the big question. And when you look at but finally we're starting to see broader diversification in stock prices in the S&P 500 in terms of its, right? The
other companies besides the Magnificent Seven. Which, by the way, 5 years from now, there will be a different group of stocks with a different name.
Yes.
Because we didn't talk about the Magnificent Seven 5 years ago.
It would be the Fabulous Four.
It was Fabulous something, right?
Yeah, something. I don't remember.
You know, it's funny. When you do this long enough, after a while, you come up with these, like, you don't get too caught up in whatever the latest
the hype is.
Yeah, because you know it's going to move on and it's going to be something else again.
Yes.
I was talking to a younger advisor yesterday. He'd maybe been 10 years in the industry. And we just kind of
all the advisors at the firm are younger than you. Most of them. A lot of them.
I get it. No. But there's one thing about actually living through the market cycles
versus reading about them.
Yes. Living through the market cycles.
And so
I think there's a difference with advisors who have started in their career post-financial crisis versus pre-financial crisis.
Yes.
It's a very humbling industry because nobody knows when the market cycles are going to start and end, right? And so a client could have hired an advisor at the very peak in 2007, like the absolute worst day. And no matter what strategy they had in place, no matter how conservative, dollar cost, the whole thing, they could have done all kinds of things. They would have lost money their first year and a half or so with that advisor,
which is rough. So, what was the conversation you had with this younger advisor about?
I was just reflecting on these market cycles. Yeah, and he wasn't an advisor part of a firm. He was not our firm. He was just some other advisor that I was chatting with.
It's hard. It's hard.
And I tell you, look, I this morning driving, and we'll take some calls here in a minute. Driving into the studio this morning, I'm flipping on the radio station, which I don't very often because I'm kind of like the podcast. I don't have to listen to commercials. We can fast forward them.
Like ours.
Or not listen at all. And there was some advisor advertising. Essentially, the advertisement was, safe money, you should be earning 6%. Safe liquid money, 6% should be your bogey. Call me to discuss more.
Where? Where's he get this magical, the fabulous 6% on safe money?
Liquid. So things like he said liquid. This is for your liquid investment.
It's actually, we know what it is. It's subprime loans is what it is.
Well, those aren't very liquid.
That's right. They have windows, but they could close the window.
And as I'm listening to this, I'm thinking, this advisor I was talking with this week, he's currently has charges, it's his business, flat fees for his clients, and he's going to be moving to a assets under management fee to align his interest more with his clients. And he was talking about what his fees should be and that sort of thing. And I was having a conversation with him about, and this might sound harsh, but I said, you have no reason to discount your fees. You should charge a market rate. And I said, because not only are you providing tremendous value to your clients, you are protecting them from others in the industry that do damage to people. So don't feel bad about, if you're a great advisor, don't feel bad about charging a market rate. Like, there's nothing wrong with that. Don't feel you need to discount. I said, these people don't need charity. They've got $10 million invested in them. I'm just being very transparent here, right? And then I hear this ad this morning, and I thought, that's exactly why you should charge a market rate. You are protecting people from
these 6% safe money. It doesn't exist.
When the treasuries are yielding 4%, how do you get 2% more with still being safe and liquid?
You don't.
You don't.
You don't. It doesn't exist.
I get frustrated when I hear stuff like that.
We all sense that in your tone and your voice. All of us.
This because we see them when these people come and see us after the fact.
Scott,
right? I mean, how many hundreds of people have you met with over your career that have been sold crap from somebody? That doesn't work out. Now they're trying to unwind the position. They can't.
Yes, and they don't know what to do.
Yeah, they don't know what to do.
It's difficult.
And sometimes you can't help them anymore. No. I'd love to be able to help you out. I know you're $800,000 in that position is now worth $550,000 and it's now illiquid. I don't know what to tell you.
Yeah, there's not a lot you can do.
Not a lot you can do. Anyway,
all right, we're going to take some calls.
Yeah.
And, later on in the show, so we got to hit this, Scott. I want to talk about this Cambodian conglomerate.
I don't even know what you're talking about.
Well, that's why I'm talking about it.
Cambodian conglomerate.
Called the Prince Group, where they've been sanctioned by the U.S. government for pig butchering.
Well, that'll keep everyone tuned in. That's a forward tease, they would call in the industry.
Oh, yeah. I've been brushing up on
it's so good, too. Like,
I've been brushing up on my radio skills.
Honey, I'll be in the house in a moment. I got to wait for the rest of this program.
Or I just put it on pause.
All right. If you want to join our program, I talked to a buddy of mine yesterday. Hey, you can't take live calls. I said, no. I said, we record the show during the week, and we schedule our calls. One, we get better calls this way, so you're not wasting your time on bad calls. But two, it enables us to have a
cushy lifestyle.
Cushy lifestyle. Well, 20-some years we did it live.
That's
on
right.
the weekends.
Every weekend.
Yes. So, I can tell you this: we would not be doing the program today if we still had to do it live on the weekends.
Oh, that's right. And I cannot tell you how many soccer and Little League games I missed, and for that I'm thankful.
That's not nice. Anyway, if you want to be part of our program, you had a question for us, love to take it. Questions@moneymatters.com is the best way to reach us with your question. We'll schedule time. Questions@moneymatters.com. We're starting off here with Gerald. Gerald, you're with Allworth's Money Matters.
Hi. Thank you for taking my call.
Yeah, glad you joined us.
I've been off and on listener since the early 2000s, so I'm glad you guys are still here.
Oh, I appreciate
me too.
Advice.
Appreciate that. How can we help?
Your program.
Thank you.
Okay.
How can we help?
I am a trustee for my parents' trust account, and both parents are retired, and my mom passed away recently. So my dad is a surviving spouse.
How recent? By the way, sorry about how recent did she pass away?
September last month.
Okay.
And now my dad's monthly income is $1,900, and he has an expense of $7,500 a month. All their assets is cash. and checking and savings accounts. They have an IRA, very small, $2,900 for my dad and $3,500 for my mom, respectively. And what I like to do is to invest some of their cash in the stock market so my dad can get more income and better return on investment rather than the puny interest rates in the bank of 0.01%.
How old is your father?
97.
And how much money is in brokerage accounts or bank accounts?
850.
Wait, but
$850K.
Okay, thank you.
Sorry.
So that's
I assumed
that's
it was
all in cash.
I assumed it was $850,000,
Yeah.
not $850.
Yeah.
And
How
many,
much of this do you think would you invest in the market?
I don't know. That's why I'm calling. I'm thinking right off the get-go, 100K.
how many beneficiaries are there to the estate?
Two, myself and my sister.
And he's 97, and
Yep.
so here's one of the ways to think about it. First of all, the money shouldn't be in the bank. There's so many other investments that are liquid, that you can choose
The
from.
treasuries are paying almost 4%. 30-day treasuries are almost 4%.
Yeah. So that's pretty simple there. But let's talk about the investable part of it. If you set aside, if you set aside 5 years in cash at this amount, so you said the expenses are $7,500 a month. So that's
Let's call it $100,000.
Okay, it's 90,000, but we'll call it 100. So you set aside $500,000 and you put it into, let's say, treasury, something that's liquid and
CDs,
safe.
even whatever. Yeah.
And then you took a look at the rest of the $350,000. I would feel comfortable investing it based on how the other beneficiaries of the estate would react to this. And the reason behind that is you have a fiduciary obligation to not only your father, but to the beneficiaries of the trust. And when you look at it this way, what you're doing is, if you took that $350,000 and put all equities, you would be investing for yourself and your sister, essentially, which means the timelines are longer.
Okay.
And if your sister, she understands it and understands the reasoning behind it.
Here's the risk. Let's say you took $500,000, left it in secure investments, took $350,000, invested it. Let's say you put it all stock, which I'm not really wouldn't recommend necessarily, but if you did that, the market takes a downturn. The $350,000 goes to $250,000. Your father passes away. Your sister says, "What the heck? How'd you lose that money? You lost $100,000. That's half mine. You lost me $50,000."
That's right. That's the risk. And so it all comes back to how your sister would. So if your sister was on the same page as you and understood the risk, and
I would have have her involved in these discussions.
That's right.
And if she's not comfortable, I wouldn't do it.
That's right.
Okay, but to gain additional income for my dad, you're suggesting to put the $500K in treasury bills,
Short-term,
CDs.
shorter-term fixed income.
Yeah,
A
short-term.
combination of things. But
Yeah, which has some sort of a government guarantee.
How about dividend in EFTs?
It's not appropriate for his unless look. It all gets down to the benefit. If you were the only one that was the beneficiary of this estate, it'd be easy.
yeah, particularly if you had other assets in case things went sideways and your dad needed some money, if you could take care of him, then it would be even easier.
Yeah,
Okay.
and in fact, I would make the argument that if you have other assets and your sister has other assets and you're all on board, then I would probably set aside even less money than the 5 years and go to a fully diversified portfolio. But at the end of the day, it's not what's the best portfolio. It's who are the people involved in the transaction.
Okay.
So is your sister, is she fluent in finance?
No, but I could talk to her.
All right. I'd give it a shot.
Okay.
Yeah.
So,
And I would use an advisor
I would absolutely use an advisor.
because you're a fiduciary. You have a legal responsibility for the beneficiaries to manage these monies for your father and for the subsequent beneficiaries. That's your duty. If you hire an advisor, it reduces your risk dramatically.
Yeah. And
Okay.
and it's a lot of it has to do with her view. If she is
Prudent investor rule. I think that's what
That's
call
what
it.
they
It used to be
call it.
prudent man, but
but if your sister has plenty of other assets and you have plenty of other assets and you both understand the risk involved, you can put more risk in the portfolio, which will give you a greater long-term rate of return. The question is, how are you going to react? Let's say we're in a 35% down market on the day your father dies and this money goes to your sister and she was going to use it to pay off the mortgage and send a kid to college, then you've got problems. But if she said, look, I can weather this stuff for another 5 years, 3 years, it doesn't really matter, then it would drive the investment making decision more aggressively.
Okay.
Does that make sense?
Yes, it does.
Yeah. So it's
But okay, again,
and I would make sure the more risk you take,
income. Okay.
the more risk you take, you need to make sure that you've got the money to provide
that $7,500.
Yeah, I'm sure he's in a
for
home of
his
some sort.
for his expenses.
If he lives another 10 years.
Yeah. All right.
All right.
So you had a
Thank you
question about the
for-
fixed income? Just buy either.
I use an advisor and put together. You wouldn't just throw it all in a treasury. You would put together good.
Yeah, fair enough.
Hire an advisor to help you put together a proper fixed income portfolio for that on the liquid side of things.
So, all right.
Okay.
All right. Thank
very
you.
much.
Appreciate the
Yeah.
call. Thanks for
It
being
can
a
get-
long-time listener.
Yeah, it can get really sticky. I was talking to a friend this last weekend who's a beneficiary. His parents passed away. First parent died 4 years ago. The other one died 2 years ago, something like that. Large estate, still no distributions. The only distribution he got was a check to cover the taxable portion that flowed through to him. He got a K-1 that he learned about after he filed his taxes. His brother is the trustee. Didn't tell his siblings that, oh, by the way, you're going to have a taxable, you're going to have phantom income here, essentially, is what happened. And then he gets a check just enough to cover his tax liability, and it's been over 2 years. And his brother says, well, I'm still trying to close out the estate.
Well, it doesn't stop. Well, you obviously know it doesn't stop you from doing partial distributions of the estate.
Of course. That's what I've told my
Oftentimes
friend.
it's just control issues.
It's 100%. It's so obvious. And my friend says to me, he's in a sticky situation, and it's quite a bit of assets. And he'd like to help his kids get a down payment on a house. And he says, but I care more about my relationship with my brother than I do about any money.
Yeah. Yep. It's a very similar situation where guy lives on the West Coast, family owns a house in Kennebunkport, 80-year-old house, nothing fancy, but it's worth $4 million.
Kennebunkport, right on the water or something, I'm guessing.
Yes. And within 3 hours drive from both his brothers to use it as a vacation home. So it stays in the estate.
Did they hit him up for cash to help on the repairs and property taxes and everything?
No.
Okay, that's at least.
But his point, as I pointed out to him, because he lives close to Lake Tahoe, I said, if they paid you out your portion of it, you could buy a house in Lake Tahoe and get some of the benefits. But he says, well, I go back there about once a year and we vacation for a week. So it's how you set up these estates is, especially if it's sizable, is really, really important. Because you could write that in. You could say the house needs to be liquidated, or fair market value could be sold to any or all of the.
I've had a cabin in Tahoe for 20 years, almost 20 years, and my daughter, who hardly ever uses it, she'll be there maybe a week in the summer or something. Like, Dad, you got to promise me you never sell that. And I'm thinking, no, I'm not going to promise you that. Number one, number two. I think that I would like that liquidated if your mother and I both died. There's no sense. I've got 4 kids. Like, to your point, I don't want them to deal with.
Yeah. What happens if one ends up living in Boston, and the other one ends up living in Sacramento. So one gets 80% of the benefit,
Yeah, that's
one
right.
gets 20%.
It can get complicated. You want to make it as clean as possible for your heirs.
Yes. And don't require them to own anything, my advice, after you die. Which means don't set up a perpetual trust
That's the same problem with the same estate. There's commercial properties that this guy, the dad, had with another gentleman, and they said, no, you need to keep these properties for 10 years post my death.
Oh, why?
So that the other partner hadn't have to sell and pay the capital gains taxes.
Okay.
So that, I mean, you think about the challenge that is. You're telling somebody you got to keep a property for 10 years. Maybe it's a warehouse somewhere that's got leaky roofs that falling apart. The tenant quit paying, and all. I mean, I'm just like This is a close friend of mine. I'm hearing this. What a mess it is right now, and it's no one's benefited yet, except the brother that gets to control. Whether he thinks he's doing out of love for his siblings or not, it's a control thing. It's obvious
It is
to
control.
me. Obvious.
Yeah.
Anyway,
Younger brother, older brother?
younger brother.
Oh, it's payback.
Remember that time you used to punch me?
Remember that time you locked me in the closet?
All right, let's continue on. We're talking to Sharon. Sharon, you're with Allworth's Money Matters.
Hi, good morning.
Hi, Sharon.
I have a complicated but interesting question about a deduction possibility for grandchildren. My husband and I are retirees. We recently purchased a fixed annuity for $1.4 million. And at that point, my adult children, who have two small children in preschool, asked us to pay for preschool, which we're happy to do if we can afford it. And the preschool is in the state of Washington. We're in California. And I was wondering if the $40,000 the $4,000 per month that we're paying in tuition is deductible in any way to us.
No, it's not. It's not deductible.
If the school was a nonprofit, religious or some sort of nonprofit, and you gave a $100,000 check to their campaign of some sort, and the school was then able to offer tuition at a reduced amount, theoretically, you can get some tax. You can get the tax deduction on the gift.
You could get.
You couldn't. There's no quid pro quo, so you couldn't say, "Hey, wink, wink. I'm going to write you guys a check. Can you have my grandkids come and do low tuition or free tuition?" That's not going to work.
That's right. You can't take a tax deduction for a charitable contribution if there's economic value to you in that gift. So the answer to your question is no. There's no deductibility part of it. But let's step back for a second. Why did you mention the annuity?
Well, because we're using money from the annuity which is taxable. We're using money from the annuity to pay for the preschool.
Okay, and is that an immediate annuity where it started distributions of income immediately based on your life expectancy?
I don't know if it's based. It's based on. We paid this amount. It's a fixed annuity, and we get something like not enough. We get $9,000 a month out of it.
Okay. So
it's an immediate annuity.
It's an immediate annuity.
And so when you both pass away, it's gone. Is that correct?
It's gone. It's till age 80, and then we have another annuity that kicks in from 80 onward.
Oh, got it. How old are you now?
65.
All right, so it's a 15-year annuity.
Right.
And how much is it paying a month?
It's paying out like $9,000 a month.
It shouldn't be all taxable. If it's an immediate annuity, that your check is two things. One, it's a return of principal, the money that you invested in this
which
annuity,
is not taxable.
and the second is the interest on that, which is taxable. So over a 15-year immediate annuity, maybe half of it's tax-free.
So it should, now, if you're taking withdrawals from it and not annuitize
but $9,000 a month on $1.4 million is more than the interest.
That's right.
So it sounds to me like it's an immediate annuity for 15 years,
fixed
and then they sold them another annuity
to layer it.
That's going to be paying at age 80.
Okay. So the answer to your question is no, it's not tax deductible. But if you think you have ample assets, it may make sense for you to fund a 529 plan for your grandchildren in the future, right? Where you make the deposits, it grows tax deferred, and it comes out tax free as long as it's used for education.
And the big beautiful bill just increased what qualifies as
secondary primary education.
It's now high school tuition. I don't know about other private school for elementary. I don't recall off the top of my head, but
it is for high
school.
So if in the planning process, if you have ample opportunities, you can actually set this up where you're the owner and the child is actually the beneficiary. You make the deposits very similar to your annuity. It grows tax free, and it comes out tax free as long as it's used for that education. So you don't pay any tax on that growth.
Do you have much in assets outside of the annuities?
House and more stock accounts and
Okay.
Yeah.
That'd be the best way to go about it.
Yeah. But make sure it's much like that annuity. Once you put it in there, you can't get it back out. Much like your immediate annuity.
Right. That's a really good answer. Thank you. I appreciate it.
Okay.
Yeah.
All right. Appreciate the call.
That's why, Pat, it's like the financial planning. People ask about what's a good investment. They're like, well, I don't know. What do you mean? What is a good, right? What's a good investment right now? Well, you look at a situation like this. So they're trying to help their grandkid, which is great. What a blessing to do. I hope when I have grandkids, I can be able to help something like this. Feel good about it. Helping their
How about the grandkids? Why does it always have to be about you feeling good about it?
Well, you had a good point. I'd feel better if my kids had enough money to support their own family. Okay. Now I think about it. I'd feel really good if they didn't need my money.
Okay.
My point is here, if they're paying for preschool, there's a good chance they'll help pay for education
in the future.
High school, elementary school, college, even. A 529 plan is a phenomenal vehicle for particularly a grandparent who wants to help a grandchild.
Exactly. Especially if they're the owner.
They can still control it, but when they put money in, it's out of their estate. They can give how many years of, I think it's 5 years. You can give a big chunk.
It's 190. I looked it up.
190. All right. It's almost $200,000 they can stick in per individual.
Yeah. I think it's 190.
Whether or not that's the right thing to do, I'm not saying that you should.
You got to make sure you have enough in your estate.
Yeah. You don't want to give away money that you might need in the future.
Yeah, I was talking to a guy that recently sold his company for $100 million.
He should have enough.
And, well, I'm hoping. And he was talking about it. I said, well, you've got grandkids. Why don't you do this thing first? And why don't you do it all at once? Like, not every year. Just get it out so that it gets more tax-deferred growth on that in there. But you have to make sure that you have enough money to retire comfortably.
Yeah, to support your needs. I think at $100 million, he's probably fine.
I think so.
Yeah.
He's got a really nice boat, though.
He's a good friend to have.
He's got a 35-foot Formula bow rider. Very nice.
It does sound nice.
It is a nice boat.
I remember seeing some Tahoe a couple of years ago, and this brand new wooden Riva. The boat was over $1 million.
Wow.
Not a huge yacht. We're talking about a runabout.
Yeah.
But,
but it's wood. It's Riva.
He just, and I'm like, some guy just sold this business. I'm like, that'd be the last thing I'd want is some boat that, anyway, back to this. The whole concept with planning, right, is from a tax standpoint, having interest that accumulates in the 529 plan is much better than having interest accumulating in the annuity that then becomes taxable.
Significantly. Significantly.
Which is why, in order to make any sort of an investment recommendation, one needs to take in consideration what all of the objectives are, what someone's trying to accomplish.
And risk tolerance. My guess is their risk tolerance, Sharon's risk tolerance and her husband's is relatively low.
If you're going to be putting that much money in annuities and then layering them,
your risk tolerance is relatively low.
That would be
not good or bad. It's just what it is.
I personally probably wouldn't not have like to say emphatically, I wouldn't have recommended the immediate annuity strategy. I take that back.
Yeah, you would have. Maybe.
Yeah, there's times, and there's non-commissioned annuities now too.
That's right.
So a fee-based advisor can recommend a non-commissioned annuity. But the thing with an immediate annuity, once you write that check, that asset's no longer yours.
You're buying a pension.
And that's why I say I shouldn't say emphatically, because there are times that I have recommended, and there'll be times in the future I'll recommend it again.
Yeah.
Let's continue on here. Talk with Lori. Lori, you're with Allworth's Money Matters.
Yeah, hi. Thanks for having me on.
Yeah, glad you joined us.
Well, I've got a couple of young adults who, as you would say, are not yet self-feeders.
Thank you. That was my dad's term, by the way.
Self-feeders.
Although, they're both in school, so hopefully they're going to be working their way toward that. And I just kind of wanted to run by, am I doing the right thing with them in terms of money-wise right now? So they're both in school. They both got part-time jobs, and one of them has no impulse control whatsoever. One, I think, has sort of a handle on that kind of thing. So the one who it will blow through money if she has the opportunity is 19 years old. So she has a job right now. So I've basically told her she needs to put that money into Roth, and because she's at home, I'm paying for all of her bills. Although because of her ability to blow through money, I did tell her she has to pay me for her car insurance and she has to pay her own gas.
Very
just
nice.
to give her a bill.
Yeah.
Not because it's something she can't afford, but just to give her something.
Yeah, of course. It's trying to teach her to be an adult, to be a self-feeder.
Yeah.
And discipline.
Right. So, I know she's 19, so technically, she's an adult. She can do what she wants with her money. But
she can also leave the house and go figure it out on her own.
Well, and that's not happening anytime soon, apparently. So, in terms of that, so I basically said she has to put 75% of her paycheck into a Roth IRA because I'm just trying to, quote unquote, lock up her money now while she has her bills paid.
Perfect.
She can still go out and pull the money out of that Roth.
Yeah, I haven't told her that though.
Yes.
I mean, let's hope. So you're trying to teach her some lessons here, and also help her by having some money set aside. And one would hope that if she has that urge to pull the money out, she can realize, I don't think I want to cut my ties with my parents on the financial end of things, which is probably what would happen. That's what I would do to my kid if they did something like that. I'd go figure it out on your own then. So it's not going to be enough there to actually do any real damage to herself.
So I think it's a great idea.
I do too.
Well, and the other thing I'm wondering about is, I feel like the advantage, I keep telling my kids, you're young, you're 19 and 24. You put money in this stuff and look at look what happens over time for your retirement. So if we just focus on that, because once hopefully they get out of school, they have a job, then, they're on their own in terms of now they're self-feeders. But right now, the one thing I can do I'm hoping is given the advantage of time and, compound changes and that kind of stuff. So my other thought is, if I can afford it, should I do this sort of, I think it's $16,000 a year that you can give to somebody without tax consequences.
Yeah,
for them.
18.
Oh, 18 now?
Yeah,
okay.
for both you and your spouse.
Okay.
Per individual.
Okay. So is that something, is there anything else I'm missing in terms of, I kind of feel like if I can get them to do this now
but you
in a Roth IRA.
You can't put 18 grand in a Roth IRA because that exceeds the limit.
Yeah, it's based on her income.
Right.
How large is your estate?
I mean, at this point, I'm set. Like, okay. I'm happy. I'm not going to
$5 million or?
No. It's like 3.
I would not. I would not start gifting.
Okay, and why?
Well, I would disagree.
Why?
I've with my kids, their first jobs, I would put money in the Roth IRA for them. They earned $3,000 for that summer. I'd put $3,000.
She's already got the child putting in 75% of her. If she wants to top it up to go to 100% of pay.
Well, and I will. I'm going to, whatever they make this year, they're going to go in the Roth, and I'm treating my kids differently. My daughter,
That's fine.
I'm telling her she has to fund her own Roth as much as possible. My son, no, because he's reasonable with money and he has other expenses and whatever. So, but my plan is whatever they make this year, they're going to put in Roth.
Okay,
Whether
perfect.
it's me and them or just them, however that goes.
And I agree with Pat. I would not transfer money, give them money in addition to the Roth.
That's correct. That's what I said.
And
Yeah.
and see, no, and why? Because again, my feeling is if I put that into something that they could put in equities or whatever like that, they've got decades.
Oh, I understand,
for that
but
You can own it and transfer it to them later.
Yeah, and you get a full step up in basis at either your death or your spouse's death. So I would make the argument, because you don't have an estate tax problem. What's the limit for the estate tax?
It's $30 million next year.
For
Husband and wife.
For husband and wife. So because you don't have an estate tax problem, I would make the argument that it's better off in a tax-efficient portfolio in your name, with the idea that it's going to go to them because you'll receive a full step up in basis at death. And the compounding, actually, you're right, and you're still taking advantage of the compounding, but you've got this tax efficiency that's built into it at death. And we're not trying to shrink your estate.
And worst case, the step-up basis goes away and you transfer the shares to your kids, and it's the same thing as them having it now.
From the very beginning. So I wouldn't go above and beyond the Roth. I wouldn't be using up any part of either my exemption amount or even.
Here's one thing to keep. So we each have 4 kids.
Mm-hmm.
They all very different with their finances. My 18-year-old freshman in college, she blew through $1,000 her first month. The money she had set for the whole semester, essentially.
Gone. Yeah.
I give her a tiny allowance because she's got her meal plan. And I look at her, I just looked at it a couple days ago, and I think she's got like $20 left, right? And I'm like, well, I guess you're not going to have a lot of fun the next couple months because I'm not helping you anymore, because I'm trying to teach her that there's consequences when you spend your money, right? You can only spend $1 once. And but the reality is we try to teach our kids these values, particularly the values that are important to us, right? We hope that our kids are going to have those same values as they go through life. And the reality is they have their own values, whether it's financial or in every other area of life. They typically don't mirror our own values.
But they're going to be themselves.
But
as we all know, as we've raised kids.
But this Roth is very, very valuable. It's a great teaching. And here's the reality. My very first job out of college, I started putting money in the 401k. I took that money out of the 401k to fund opening Hanson McLean 30.
You borrowed $10,000, and I would have done the same, but I didn't have $10,000 in an IRA.
I had $10,000 in an IRA, and I borrowed it out for 60 days to start the business. Mm-hmm. And that was 32 years ago or something. 33 years ago. Yeah. So and the Roth is actually because you could pull your principal out without any tax consequences.
They're fantastic.
So they might want to use it for the purchase of a first-time home. I would just talk about all the benefits of it, and then talk about compounding growth.
I'm keeping it really simple in terms of I'm locking up her money.
That's right.
It's sort of, if you will, just to keep it, like the same thing. I put her on my credit card. I was gone for 2 weeks. I cannot tell you how much DoorDash happened in that time. It just, she is going to be who she is, but I keep telling myself we've got 6 more years, so she has a prefrontal cortex. Maybe things can change. So.
They're all different. That's funny.
Yeah.
That's funny. Yeah, I think you're on the right path, but I would not gift above that at any point in time unless they change the estate tax rules.
So just wait. They have to wait.
Yep. And you might, when they purchase the first-time home, you might want to lend it to them and or
gift it or whatever.
But not just out of.
Well, and that's my understanding is there's some, I'm going to get the numbers wrong, but you can gift $1 million over, I've helped somebody else with a down payment for their house.
Yes.
Their initial thing like that. So my understanding is there's some separate category about that where again, if they get a house, I can do a down payment for them, and it's within. I don't have the right phrase for it.
Okay, so
but it's a lifetime giving thing or something.
Yes.
Like that?
So there is a gift and estate tax. It's one and the same. It's a lifetime gift and estate tax. And next year it's $15 million per individual. So a couple can do $30 million. And this means that either their estate when they die or while they're living, they can transfer that much, gift that much to whoever they like, whether it's their kids or their favorite talk show host or whatever, right?
Keep it going.
So, like, my oldest daughter's 29. She was not great with money when she was younger. Now she has her own business, works her butt off, does very well. Her mother and I gifted her some money for a down payment for her house. And it was more than the $38,000 that we had, or $36,000 that we were limited to. They get $18,000 per year.
Right.
And so we used up part of our what's called lifetime exemption. And then we had to file a tax return, a gift tax return.
But there's another way you could do it, which is you lend them the money and you put an interest rate, a fair market interest rate on it. And then every year
you forgive
a portion of that loan that is equivalent to that $36,000 until the loan goes away. And that way you haven't used up your exemption.
They have to pay the interest.
They have to pay the interest, but it's just a transfer of money internally, quite frankly, because you're forgiving the money, interest is actually coming back to you.
Right.
So depending upon the size of your estate, sometimes you do it like Scott did. I did it with a combination of the two of them with my kids. So two of my children bought homes, and I did a combination of the two of them. And one's in law school. I got to tell you, for a daughter that didn't want to go to college, she sure likes school now.
Are you paying for her law school?
It
sounds like a yes to me.
No. She got a full scholarship.
All right.
Oh, God bless her.
Yeah, pretty good.
And you.
pretty good grades. So there's lots of ways you can go about doing it. But I love the fact that you are using this as a time to actually educate.
Well, yeah. I mean, I feel like, my hope is that they'll make some good decisions. But right now, they've got different stuff. And I'm a widow, so I can't do the whole, husband and wife giving kids. I don't have that option. It's me. So I just want to make sure that I kind of got them set up, but not in a way that they've got 529s. Pretty much their school is going to be covered. Like that's a pretty,
luxury.
They're lucky kids to be able to have that. Exactly.
Yes.
So, they're going to get out of school eventually. Hopefully without debts. So it's sort of like I just want to help set him up for what's their retirement stuff.
Yeah, I think some of us are born savers and some of us are born spenders. It just seems that way to me, right?
Yeah.
So she's a spender. She's just like other areas of our lives where we have certain temptations. Part of maturity is designing our life in such a manner to put some protections in place so we don't succumb to those temptations. Right. And for her, spending money is going to be one of those temptations. And she's going to have to learn how to budget her money, how not to go spend money on an impulse. But she's eventually going to have to learn that on her own.
Yeah,
you can help guide her and teach her.
Absolutely, yeah.
But
she's going to be your own person.
Yeah. So.
Yeah.
All
right.
All right. Appreciate the call.
Yeah.
Okay.
It's funny.
It's funny because I think it's fun is talking to young parents that have kids that are 2 and 4. They got it all planned out how everything's going to work out so perfectly and
Scott,
all that.
that was you.
I know it was me. It wasn't. It's every young couple.
Oh, it wasn't me.
No.
I just we'll see how it goes. Do you remember what you said to me years ago?
Oh, apparently I said something that you stuck with you.
What was that?
I apologize in advance.
Your kids, you said, if I knew I didn't have any control, I wouldn't have tried so hard. When you're talking about raising your kids.
Oh yeah.
You said if I knew I couldn't influence the outcome that much, I wouldn't have tried so hard. But then you reflected on it and said, but I had to, and you did. You made a difference. You didn't run willy nilly.
Well, so
you imprinted some values on them.
Oh, for sure. And I still have those conversations with even my older kids.
I had one this morning.
But my wife and I, for those that don't know, we raised 2 kids and then we adopted 2 girls from the foster system when we were empty nesters. They were 9 and 6 at the time. This was 9 years ago. And I had a friend visiting with us for a while. It was for the afternoon or whatever. And he says to me, Scott, you parent more like a grandparent than you do a parent. And I took it as a compliment. I don't know if he meant it as a compliment, but to your point, you kind of realize that some of these things, maybe you don't sweat the small stuff. That's just how I
let it go.
Whatever,
Let it go.
Whatever.
Let it go. All right, before we go, I was talking about pig butchering.
Which Super excited.
This group in Cambodia, but this is the numbers that astounded me. The Justice Department sees $15 billion worth of Bitcoin from this guy.
Here comes the
right? $15 billion.
I did see a headline on it.
$15 billion in Bitcoin. Americans lost at least $10 billion to scams originating from this region in Cambodia where this guy operates. They have hundreds of thousands of employees that operate in this pig butchering, and these are romantic scams.
So it's not a pig.
No, they call it pig butchering because you fatten these people up through romantic scams and then slaughter them at the very end. So they're multi-months, if not year, relationships where people think they're in a relationship.
I had a family member, almost. I mean, this relationship went on months, several weeks.
So
all scam.
The point being here is that if you have a relative that you think is susceptible to this, be it young or old,
they say $10 billion.
Americans lost at least $10 billion to scams originating just from this region in Cambodia. This is a region outside of Phnom Penh that has lost it. The enterprise employs hundreds of thousands of people. The enterprise, which is there are multiple of these pig butchering. But the point being, if you have someone who's close to you that you believe is even slightly susceptible, get on their account somehow to monitor them. You can be CC'd or get on the application so that you see transactions. In any of the big brokerage firms, if you got an app on your phone, you can actually, ask to have permission so that you can monitor this. And it's real. It happens every day. I read an article from a local newspaper this morning. This person wired $125,000 in a bank fraud. It was a bank fraud, and the local authorities were able to get $97,000 of it back, which I thought was pretty incredible. Wow. But they're called pig butchering. So if you have someone that's susceptible, you believe to be susceptible, start monitoring their accounts.
And have a conversation with them too.
Oh, please.
Yeah.
Please.
Hey, it's been fun doing the show with you, Pat, and I appreciate the callers. Again, if you would like to join us, have a question for us, just send us an email, questions@moneymatters.com. And if you like our program, a couple things. One is let others know. Some friends, forward this on, and then also follow us and give us a review. We'd appreciate that. So this has been Scott Hansen and Pat McClain of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.